Hi, good morning. This is Dr.S.Valluvan from MBA, Dr. SNSInstitutions College of Arts and Science. This video is about financial management, an overview and the nature and functions of financial management. Financial management is broadly concerned with the acquisition and the use of funds by a business group. It refers to planning, acquiring, utilization, and controlling of financial resources activities. It deals with investment decisions, financing decisions, dividend decisions, liquidity decisions, and budgetary control, etc. Now, see the definition of financial management. According to R.C. Osborne, the finance function is the process of acquiring and utilizing funds by a business. See, in a simple terms, we can define the term finance. Finance is nothing but a management of cash or money management. By using the money, how a firm or a business acquiring assets and the proper utilization of those assets is all. What about that? Move to the objectives of financial management. A financial manager needs to evaluate the factors uh, for assessing the capital needs, such as the cost of current and fixed assets, cost of marketing, need for buffer capital, long-term operations, and the human resource cost, etc. Successful business have clearly defined short-term and long-term financial requirement projections in place. The next objective is a determination of capital structure. Of course, the capital structure of a company includes debt plus equity. A company's capital structure is a framework that determines the decisions such as debt-equity ratio in short as well as the long term. The company has to decide, say for example, if a capital of the company is 100%, the financial management helps the company to decide the capital structure, which is the optimum capital structure of a company. So the company wanted to go for 50-50, 50% equity, 50% debt, or it is 60-40, or 70-30, 70 equity or 30 debt. So to decide the optimum capital structure of a company, financial management helps the businesses. Then the next objective is a creation of effective financial policies. There is a need to frame efficient financial policies that govern cash control, the lending and borrowing process, and so on. Resources optimizations. Great financial managers are able to navigate through different scenarios by taking optimum use of available financial resources. This would reduce the cash burn and increase the cash churn to generate maximum return on investment. Now we move to the scope of financial management. The following are the scope of financial management: estimating financial requirement and deciding capital structure. Third one is selecting a source of finance. Fourth one is selecting a pattern of investment. Then proper cash management, implementing financial controls, proper use of surpluses. As far as the estimating financial requirement is concerned, a business has to estimate the cash requirement for its smooth business. See, we can classify the business activities into three. Whatever the business may be, it may be a small business or a large business. The classification of business activities are three based on their nature. Based on their nature. First one is operational activity, then investment activity, then financing activity. So based on this, the funds can be generated and those funds can be properly allocated for these three business activities. Then we move to goal of financial financial management. Profit maximizations, maximizing earnings per share, and shareholders' wealth maximizations. See, the profit maximization is a traditional approach, whereas wealth maximization is a modern approach. Shareholders' wealth maximizations can be otherwise called as value maximizations or net worth maximizations. We'll be see as we go along. This is a profit maximization. Profit maximization is the traditional approach and the primary objectives of financial management. It represents the process or the approach by which profits EPS is increased. The advantages of profit maximization's goal is economical survival, measurement standard, social welfare, economical welfare. See, for every business, profit is the main motive. Apart from the profit maximizations, the main primary goal, according to a modern approach, is wealth maximizations. That means you want to increase the value of your business. So that is the primary goal of any business. You want to satisfy your shareholders. You want to satisfy your shareholders means you want to increase the value of the business. So that is the primary motive. That's what all about the wealth maximization. Wealth maximization means maximizing the wealth of the shareholders in terms of market value of the shares and the value of the firm. This involves increasing the earning per share of the shareholders. Wealth maximization is regarded as operationally and managerially the better objective because the time value of money, the risk or uncertainty of future earnings, effect of dividend policy, and the market price of the share. Thank you.